Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets.
Welcome to this week's Supernatural Stocks. I must apologize for my voice. Unfortunately, I have a cold. This is the best I've sounded in the past couple of days, so I had to pull the trigger on doing this podcast, and we'll just have to do our best with this ghosty voice. Okay, let's get into it. So if we are going to compete in the Olympics or the MMA title fight of retail, then surely it makes sense to send our best fighter for comparison purposes. So there probably wouldn't be too much debate around putting the Brackenfell Bruisers forward as our contender. Shoprite has dominated the local retail landscape and is slowly expanding beyond its core grocery competency as well. Naturally, the US would send their finest supermarket options in the form of Costco and Walmart. Now, this may sound like an unfair fight to you, but just remember that you are quite entitled to do exactly the same thing with your money, and that's the point I want to make here. You can choose to invest offshore or locally, which is why I strongly advocate for lifting your head to global opportunities. Even when you have an edge in your local market, thanks to being exposed to the color of the delivery scooters all around you, that might not be enough to outperform the global alternatives. Before we go any further, it is critical to point out that we need to make these comparisons in dollars. It doesn't make sense to look at rand percentage returns on Shoprite and then simply compare that to the percentage returns in dollars for Costco and Walmart. It doesn't work for anyone to achieve great growth in a currency that is going backwards, as shareholders in the likes of MTN have learned the hard way about Nigeria. That's just an extreme example, whereas with the rand, it's more of a slow burn over the past decade. Just look at Standard Bank's latest numbers as well, where the African businesses are doing well in their local currencies, but ultimately delivered disappointing numbers in rands. Due to the relative inflation differences and of course the risks in different markets, an emerging market business needs to deliver significantly higher percentage gains than a developed market business in order for the performance to be considered equal on a risk-weighted basis. Even if all your expenses are in South Africa as an investor, the dollar is the world's reserve currency and is the right unit of measurement for growth in your wealth. So let's dig into the performance. A 10-year view is a great place to start because it shows just how dangerous macroeconomics can be if you get them wrong. Over this period, Shoprite suffered through a large part of the lost decade in South Africa, which means substantial depreciation of the rand. On top of that, there was a misguided foray into Africa, with Shoprite desperately looking for growth in companies where the governments were not breaking the place. But sadly, such places are rather hard to find in Africa, with many corporates having been burnt by this strategy in a variety of countries. Shoprite was one of them, which is why the underperformance over the past decade is quite frightening. In dollars, Shoprite's share price is up just 7% over 10 years. Not per year, but in total, 7%. Over the same period, Walmart is up 177%. As for Costco, it really is a bit ridiculous actually. The share price is more than 600% higher, making Costco effectively a 7-bagger over that period. Round 1 definitely goes to the US, with our local hero having been pummeled in the corner. The lesson here is that if you're going to invest in a country, you better make sure that country is headed in the right direction. 10 years ago, South Africa was in much deeper trouble than any of us actually realized, and the results of that are now clear. Onwards we go to round 2, which is a 5-year view on these companies. This starts in 2019, so I like 5-year views at the moment because it gives us a view of performance since pre-pandemic levels. This has been a completely different period in Shoprite's journey, as the past few years is when the group really started to shine. It certainly helps that their main competitor, Pick n Pay, fell by the wayside. Shoprite was able to win market share and deliver a great new on-demand strategy, literally. We also saw people spending far more on eating at home than at restaurants during lockdowns, which certainly helped. In dollars, Shoprite's share price grew by 76% over 5 years. That's a strong performance from our local hero, but was it enough to win this round? Alas, the sheer extent of economic stimulus in the US has put their stars way ahead of Shoprite again, albeit by a much smaller margin than the 10-year view. Walmart is up 94%, remember Shoprite was 76%, so that's a bit closer. Costco, though, steals the show once more, up 213% in 5 years. That is clearly another round to the US. So round 3, and it's the 12-month view. Do we finally actually get a point on the board? Sadly, the answer is no. Shoprite is up a commendable 21% in dollars. Again, a great return. But Walmart is up 31% and Costco 54%. Here's a fun fact, though, that makes the 12-month view quite different. The rand has strengthened against the dollar over 12 months. So Shoprite's dollar performance is actually better than the rand performance in percentage terms. Still, it hasn't been enough to beat the US-based retailers. This is ultimately a cautionary tale about the sheer importance of macroeconomics in any investment portfolio. Even if you pick a best-in-class company like Shoprite that delivers really strong results when viewed in isolation, you could well still underperform an equivalent company, not even necessarily their best choice, not even Costco, but Walmart, in a better region because of the macroeconomics in that region. So this is the top-down approach to investing, and it is an important one. There is a very big caveat to this, though, the valuation. If you overpay for a global superstar, you are in trouble. Multiple expansion has been the feature of the US market over the past decade, leading to interesting decisions like Berkshire Hathaway cutting its stake in Apple recently, something I've touched on before in supernatural stocks. Multiple expansion is why Costco's performance has just blown away the others. 10 years ago, it was on a PE of 26.6. Today, it's at literally double, 53.6. That is extraordinary. Now, to be fair to them, they've achieved a lot of earnings growth as well, which is why, combined with that doubling of their multiple, they've smashed Walmart. Because the interesting thing is that Walmart's earnings multiple has also doubled over 10 years, from 16x to 31x. Shoprite, on the other hand, over 10 years, the multiple has gone from 22.5x to 25x. Barely an increase at all, and very dependent on start and end dates on that analysis. The US market has heavily re-rated higher, and the local market has not. And this is why our local returns have been crushed over that period, especially when you combine that with the rand depreciation. Will the much improved sentiment after local elections and the US clearly trading at ultra-hot valuations give us a different result over the next few years? Well, I wouldn't bet against those Brackenfell bruises here, even in dollars. South Africa loves an underdog, and we do punch above our weight on the global stage. The thing I want to leave you with today is that offshore exposure is powerful, but it can be dangerous. Buying US stocks at immense valuations is looking for trouble. The returns that Costco has achieved over the past 10 years are not going to come, in my opinion, over the next 10 years. How can the multiple double from where it is today? Be very, very wary of multiple expansion and take a leaf out of Warren Buffett's book with how they've cut their position in Apple. Once the multiple stops expanding, your only share price growth is coming from earnings growth, and that is a much smaller percentage than we've seen from these companies over the past decade in the US. Thanks for making it this far and suffering through my dodgy voice. By next week, hopefully, I'll be back to normal.
There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.